folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. And we thought we'd come to you today with a bit of a rationale on why we're not huge fans of market timing. This is something that comes up pretty frequently. It's probably one of the most frequent things that I get asked about as a Chief Investment Officer. And it's a lot of investing, but it's also a whole lot to do with sort of behavioral finance and psychology and investor psychology and how people's minds work. And so the first thing that I would just, tell people about market timing is, most people decide to time the market when they're scared. It's like a fear reaction. And the data is very, very clear that we don't actually make very good decisions when we are scared. When you are scared, when you are under significant stress, it triggers kind of a fight or flight response within your brain, where your vision kind of narrows down a little bit to a very narrow few options. You don't actually get all that great at discerning between those various options. You lose creativity. You lose the ability to think outside the box. And actually, well documented in the literature that in that environment, you actually don't perform well from a cognitive standpoint. Whether that's on a test, if your kids get really stressed out before a test before they go to school, or whether that's a decision at work or in a relationship or anything else like that. If you feel scared and defensive, we're just starting in a bad place from a thought perspective. So there's that first point. If you're making a decision out of fear, and you can recognize at the time and figure out a way to not scare yourself or get yourself out of that scare and fear mentality, you're likely to make a better decision, regardless of whether we're talking about investing or we're talking about your job or personal relationships, whatever it might be. Second point is more data-driven around market timing. The data out there would suggest that we're actually a little bit better at the decision to sell than we are at the decision to buy in. So, statistically, when people decide to sell out of the market, they are right about 55 to 65% of the time, somewhere in that range. I always just quote 60 because it's easier. But generally, you get that decision about 60% of the time, which a lot of people interpret and say like, oh, well, that means I should sell. Or when I get this feeling or urge that I should sell, I'm going to be right more often than I'm wrong. And so I should kind of do that. But in order to be successful at market timing, you not only have to time the decision to sell, but you also need to time the decision to buy back in. Because if you sell when the market's down 10%, but then you wait to buy back in until the market is above where you sold, that creates a problem. And believe me, I see that a lot. Our decision to buy back into the market is generally right only about 45 to 50% of the time. We tend to get that decision wrong. There's a large amount of literature as to why that can be the case, but in general, it's easier to identify tops than it is to identify bottoms. Generally when the market's moving down, it gets a lot of false dips and peaks. And even when it's moving up, it starts to get false dips and peaks, and it's hard to know exactly which one of those bottoms is a real bottom versus a false, et cetera, blah, blah, blah. You can look at the charts to see that jagged momentum. The other thing that I just point out is a point about how probability math works, because a lot of you are probably sitting at home saying like, well, I have a 60% chance of getting the sale right, and then like a 45, 50% chance of getting the buy right. Feels like on average, I'm going to get that decision, right on both sides most of the time because I've got like a 50-50 chance of both of them. And that's not how probability works. If you have a 50% chance of getting the first decision right, and a 50% chance of getting the second decision right, you only have a 25% chance of getting both of those decisions correct. You can do the math at home. You got a 25% chance of getting both wrong, and a 50% chance of getting one right and one wrong. And by definition, how we kind of lay out this math That means when you make a market timing decision, most people only have about a 25 to 30% chance of actually getting that decision right. So once again, you get scared, and I know your fear sort of narrows in your brain, but the reality of the situation is that when you make that decision, you have a very, very low probability of making that decision correctly. And it's very easy to fool yourself in this. We have a number of biases that goes into our decision-making process, kind of self-attribution bias, overconfidence bias, confirmation bias, a lot of things that flow in where you're telling yourself right now, no, Rick, I'm better than that. And I would just encourage you to kind of look through the various literature that's out there on decision-making biases. You'll see that you're actually not that much better than that. We just have, our brains have a great way of convincing us that we're not going to fall into the same traps that everyone else does, despite the fact that statistically, well, I'll just put it this way, statistics generally don't lie. The last thing that I will just say on this is, if there's any evidence that I could point to, it is, actually one of the foundations of what we founded, the thing that is now known as Bluemont, RFG's investment solutions team on a number of years ago, which is the idea of bringing institutional style investing to the retail investor. There are a lot of retail investment strategies that are designed to be sold, not necessarily to serve, that rely on this idea of tactical market timing. I'm going to get the best of the market as it's going up, and I'm going to miss out on any of the downside when it's going down. And it's a very powerful sales pitch. Because who doesn't want to believe that's true, right? It's a little bit like believing that you can cure cancer with some sort of nutritional supplement, right? Like, oh, I can cure you of this thing that's really bad, but you don't have to go through any of the downsides that are normally associated with cancer treatment. That type of sales pitch is very effective because you want it to be true. You want to believe that that's possible, despite the fact of all the evidence pointing to the contrary. And I would just encourage you to kind of look at what the pros do when they're managing their own portfolios. When you see endowments and pension plans and large family offices and trusts and all of these other accounts that are managing, hundreds, tens of millions of dollars, billions of dollars. I've never seen one of them that would ever say, now's the time to perfectly sell everything out of the market, and then here in a couple of months, we're going to move everything back in, right? That is just not the way it is done on the institutional side of the market, largely because of all the data that we've just spoken about. If you ever feel like, hey, maybe I'm somehow not doing what I'm supposed to do, look at what some of the smartest minds in the industry do and take that kind of as your guide. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a fantastic day, and I look forward to talking to you again soon.